Hello and welcome to the DIY Investing YouTube channel. We are going through every stock in the S&P 500, and today is Akamai Technologies, ticker AKAM. In the next 5 minutes, I'm going to go over this company, both valuation and quality of the business. We're going to break it down right now. So, first off, this is a company in the IT services industry. So in order to understand the company, let's look at the business description. We're using quickfs.net to do this 5-minute stock analysis. They provide cloud services for securing, delivering, and optimizing content and business applications over the internet. Doesn't really tell me anything. Cloud and equipment security. Provides web and mobile performance solutions to enable dynamic websites and applications. Video streaming, game and software developing. Offers carrier offerings, cybersecurity threat parental controls, sells its solutions through direct sales and service organizations, has a strategic partnership with Qit to deliver a cure for a COVID vaccine registration. See, this company seems to be all over the place, and truly, I don't really know what this is other than really providing cloud services. Gives me some vague idea of kind of providing infrastructure to the internet. First thing that's really interesting to me, though, is beta. Beta is at 0.54. That's really attractive because it's showing that there's probably low volatility in this business. Low volatility in the stock can kind of signal low volatility in the business sometimes, and that's attractive. Share turnover, 200%, very common for the S&P 500 stocks. It's going to have high share turnover. It doesn't really tell me much. Now, return on invested capital. It looks like the company was starting up in 2001, 2002, 2003. And then kind of like slid up to this big number in 2005, but it doesn't seem to reflect the business. So I think if we think of this company as starting really a steady state in 2006, it looks like they're profitable every year since 2006. Now it's hard to tell about how stable this is, but it goes 5%, 7%, 8, 8, 7, 8, 9, 9. Pretty stable. You get into 10% in 2012, back down to 8. About 8% return on invested capital pretty stably. So you're going to need some debt in order to hit a good return on equity of 15%. If we look at the 10-year median returns, you see return on equity of only 10%. So it's either not being leveraged well enough or it can't handle a lot of leverage. And so your returns are a little lower than I would like. I want these to be double digits. Now, the PE ratio of 30, so it's being priced like a growth business. Again, I want to buy stocks generally with a PE of 15 or less, but it can be a proper valuation if you have good growth. So let's look at the growth. Revenue growing double digits over the last 10 years at 12% a year. Assets kind of growing at a similar 12% per year. And earnings per share outgrowing revenue at 14%. So you're getting a little bit of operating leverage as this business grows. Pretty good margins of 65% and pre-tax income of 20%. So I really want to understand, it's looking like maybe a high-quality business with growth, but it's relatively low returns. So what is that going on? So we see that revenue was $1 billion in 2011. Now you're in $3 billion, so it's about tripled in the last 10 years. Gross margins about 60% in 2011, and then it kind of increased to the 67% range. Fairly stable for the last 5 years. If you look at the last 5 years, 65%, 64%, 64%, 65, 64. That's a sign of a good, strong business if you have stable gross margins. Now, your operating margins has actually declined, which is less than ideal, but your EPS has more than tripled in a decade, and that's great. If you can do that, that's going to be really good. And we're showing return on equity of 14% in the last 2 years. So if this actually trends up and gets to the over 15%, this could be an attractive business. So let's go into the income statement, see what we can see here. Gross profit has tripled, just like revenue, so that's a good sign. Operating profit doubled to triple, and net income's tripled. So across the whole business, you're looking like massively good performance. In addition, we see shares are declining throughout the time. So you started at 184 million and you end up at 162 million. And it's not every single year, but you are reducing your share count. That's really good to see. Balance sheet. So we have cash on the balance sheet. Let's see. No short-term debt. Only 1.9 billion in long-term debt. How much is that compared to let's go to the overview. So it's relatively net cash, net debt. There's very little debt. This is a cash business, so there's not a lot of leverage here. Perhaps with leverage, this company could really hit a nice return on equity target. Cash flow statement. So where are we spending our money? So you had cash flow from operations positive every single year for the last 10 years. Or positive income. positive income every year for the last 10 years. That's a really good sign. So cash flow, it's more than basically tripled in that time period. What are we doing with it? We're spending a decent amount. You're basically putting all of your cash into retiring common stock every year. That's a good sign. Now, I'm a little curious where this financing is because they don't have tons of debt here. What are they doing? Is this some of stock-based compensation, or we have stock-based compensation here? So basically, some years the stock-based compensation is pretty high and has been growing, and so that's part of what this buybacks are. So they're funneling a lot of stuff into common stock. You're not getting dividends. This is an interesting business. I think it's a little too high priced. It's probably average quality to high quality. If you could leverage this up, and it's hard to tell here, and maybe you had a management willing to leverage up, this could be a very high quality business. If you can get that return on equity to the 15% range, 15 to 20% range, this could be very attractive. You have sufficient revenue and earnings per share growth to justify a high PE, but it's all about how long can that last. Can you triple your earnings every decade for multiple decades? Because that could be very attractive. But you have a lot of valuation to work off. So if the price, dropped a bit, this could be attractive. It's a maybe for a watch list. I'll have to figure this out. But that's what you can figure out on this company in the first 5-6 minutes. If you want more videos like this, don't forget to like the video and subscribe. And if you hit that bell, you'll get notifications for any future videos I upload. Don't forget that we are covering every company in the S&P 500, and I'm trying to help you learn and grow as an investor. Thank you for listening, and until next time, stop paying fees, start building wealth.